Hello, everyone. Joshua Hayes at BigWaveTrading.com. I apologize, but this one's going to be long. There's no other way to do it. Want to remind everybody, 3 weeks ago, I gave everybody a trade idea, CEIX on 8.5. I said if it didn't gap up, you could always buy it at the market. Your stop would have to be here. If you want to have a tight risk reward, I told everybody I was going to use this level. I, of course, though, get long only once it breaks out above the high of the day of the signal date. CEIX from that point to where we are at currently is up to the high of the day intraday on Friday was up 27%. Not too shabby, everyone. Not too shabby. Then 2 weeks ago, I gave you ARHS. It did not gap up, so you could have gotten long using my recommended stop level. Had you done that, from the entry to the highs, you got a 20% gain. Now, last weekend, we didn't have any new long positions. I didn't have any signals for you guys. This weekend, I don't either. But how about that timing? There was a reason we didn't have any signals last weekend, and it's because the market was extended. It was a little insane. Well, following Friday, everything has changed. So let's get into it. First thing first, you're looking at a daily chart of the SPY on a telechart platform that I use on the end of day basis. It's the old version. I'm an old man now. It's what I'm used to. It's what I like. This may look insane to you, but trust me, that's the point. The whole point of this chart is to show you there are a ton of overhead resistance levels. There are a ton of below current price support levels. It's a mess. To expect us to go one way or the other without some price discovery or some chop or slop or consolidation would be insane looking at this chart. That being said, if you don't believe, know, understand, comprehend that in an algorithmic driven market where we have continuous 90% up days and continuous 90% down days, 90% up days through here, 90% down days through here, 90% down day through here. Guys, this is brand new. This didn't exist before 2018. The market post 2018 is different from the market 2008 to 2018. It is different from the market that I have studied from 1880 to 2008 that I've traded through 1999 through 2008. Markets change, markets evolve, markets adapt, markets are geometrical and dynamic. They are not linear, static, without ever changing. If you stick to a narrative that is based off old data, old information, after new information has been presented to you, you are not a professional. You are a gambler. You are an amateur. There is nothing wrong with that, but thinking that having set hard opinions set in stone, this is what I think the market is going to do, and it's going to do it, and I don't care what data or information or weight of the evidence I get. This is what it's going to do. You're not doing it right. Just as a friendly reminder, I want everybody to pause this video lesson, go to Twitter, StockTwits, Facebook, LinkedIn, Instagram, look up Joshua Hayes, Big Wave Trading, and look at my profit and loss graph for the past year in a long only, small cap only, day trade only intraday account. Look at that graph. This is my very first year day trading full time. Look at that graph. Tell me if you've ever seen another first year day trader ever with a graph like that. The reason for that is because I've had a lot of years experience on the end of day swing side. But the whole point of that graph is that this year, my end of day graph, if I posted it, it would look basically pretty flat. There was a nice up move into April, but since April, it's come down. It's rallied off the June lows, but overall, year to date, my end of day swing account is absolutely flat. No progress has been made. That being said, am I beating the market? I sure the hell am. The SPY's down 15% year to date. My swing account's at 0%. My long-term accounts, because I was buying at SPY 400 and SPY 380, are up huge. My day trading accounts at new all-time highs. I have to say all of this because I need you guys to listen to me. What happened on Friday changes everything. It's a black swan without being a black swan event. Powell came out hot. His opening remarks were hot. They were aggressive, and he left with a mic drop. He basically said, for any of you that think that there's been a Fed pivot, that thinks that we are doing something underneath that we are not saying that we're actually doing, you're wrong, and you're about to feel, and he said this, pain. You're going to feel pain. I've never heard a Fed talk like that. As far as I'm concerned, we just saw a black swan. So guess what? Things have changed. My analysis has changed. If I would stick to the old analysis based off the new information on Friday, I would not be a professional. I would be a gambler, a degenerate, an amateur. I evolve. I adapt. I don't stay static, and I don't die. So, with that being said, let's now get into the telechart version 20 chart where I can now mark up where I'm looking for the market to pull back and what my game plan is in the long term, quarterly, and end-of-day accounts. Before we go through the levels that I'm looking to buy this market and what my new game plan is after new information that came out on Friday that we did not have before Friday, that changed everything from the June lows to Friday pre-Jackson Hole. Where have we come from and where do we stand? Well, following the bottom in the SPY, I complained about three things really. The equity put call ratio on a standalone basis never got above 1. The 5-day moving average got above 0.8, which is a sign of a bottom, but the actual day-to-day number never hit a level that I would say we've hit a bottom. We have extreme lows. The VIX somehow in January, as we sold off, never made higher highs in March, in May, in June, somehow making lower highs through the process as the SPY hit lower lows. The VIX not hitting 40 at the lows, how can we have a bottom without the VIX over 40? How can we have a bottom without the equity put call over 1? And even more important to me, every single major stock market bottom that I know of, that I've researched, that I have data evidence on, we see equity outflows. Everything, if you look at the Goldman Sachs indicators that they produce for clients, you will see everything shot to the far left edge, which means fear, panic, risk off, except for one item, the equity inflow, outflow. It remained at the hard right edge and stayed there the entire sell-off. Mom and pop never sold their 401k stocks. For every $100 that's made during the leg of a bull market, before a market bottom normally happens, about $30 comes out. You know how much has come out as we pulled here to this current day? About $2. There's been about $2 of withdrawals. If we average $100 of inflow on this uptrend, there's been about $2 of outflow. Now, that being said, could the bond market have capitulated? Absolutely. For every $100 of inflows during the last leg of the uptrend, 85 has come out of bonds since the market top. We could have a bottom there. But that being said, no equity outflow indicating capitulation. No spike in the VIX over 40, signaling capitulation. No equity put call ratio over 1 for capitulation. So then I need, if I don't get any of those to be 100% certain that I have a bottom, I need to see one thing, a Fed pivot. We never got the Fed pivot. Did the Fed ever stop hiking rates? Did they ever start cutting rates? Did they ever make mention, even before Jackson Hole, that they were going to stop with rate hikes? No. So there's no Fed pivot either. So the main sentiment or macro pivot that I need for a real bottom was never, ever shown to me. This is why I never was able to go all in with the remaining cash in my long-term portfolio. You guys all know that have been watching this video from the very beginning of this downtrend, that my game plan to go all in with the long-term capital that I raised at the end of 2021. By the way, who was telling you to do that? Who was warning you about this? I was. To go all in, I needed to see the SPY completely crash, fall 50 to 55%, get around SPY 250, and no matter how it was coming down to SPY 250, as soon as it closed to SPY 250, I'd buy it all on leverage, margin, every account, all in. If that doesn't happen, I need to see the VIX over 40, equity put call over 1, equity outflow, and or a Fed pivot to go all in. Without that, my game plan was, on the downside, SPY 400, SPY 380, and then a big load, 50% of the remaining cash at SPY 350. And then if it went to SPY 320, more, SPY 300, more, SPY 280, more, SPY 250, all in. And or if I got SPY 350, where I'm 50% all in, the Fed then pivots, and or we get that capitulation in the VIX, equity put call ratio, equity outflow, then the remaining capital all in. We got none of that. None of it. So when the market started to bounce here, pulled back, and we did these bullish maneuvers these 2 days off bad CPI and PPI data, I knew, the bottom is probably in. I didn't get any signals, but guess what? The market is doing new things that it's never done before. So maybe this time it's different. There won't be any capitulation. This is the bottom. What are the reasons that this could be the bottom then? Well, the Bank of America bull-bear ratio hit 0.0. First time since 2008. Didn't even hit 0.0 during COVID. So, okay, I got to take that into consideration. So that happened. Then consumer sentiment came in at the lowest since 2008. Okay, got to take that into account. Then the Cnbc Bullish Bearish survey came out. There were more respondents bearish than in 2008, where we were literally 48 hours away from you going to any ATM and being able to take out any money whatsoever from any ATM. 48 hours, guys. There were more bears in this survey than there was in 2008. Okay, maybe we did bottom then. So after these 2 days, I bought a little bit more in my long-term portfolio. And my whole idea was, if I can get a retest of these lows, I'll go ahead and go all in. I'll go ahead and go all in. And then this happened. All right, if I can get 370, I'll go all in. All right, if I can get 380, all in. All right, if I can get 390, all in. And then we hit the 100 SMA, where I expected that we were going to find resistance. It was a Fibonacci level, the 100 SMA, and right here, former support, now resistance, right at the 100 SMA. This is where we should turn. But instead, we did this. And guys, this is what the problem was for me. So already because of this move here, I was getting some pretty good speculative long signals, and I got a couple of good quality signals, but I didn't get any great signals. On top of that, minus the couple really good signals that I got, I didn't get any more really good signals. All the quality names kept doing this. CLFD, bye-bye, no pull. SMCI, bye-bye, no pull. SWAV, bye-bye, no pull. You had this little moment right here at the 21 SMA. That was it. And that was back here. I'm talking about once we got going. So then I'm like, oh, man. Oh, man. And as this happened, not only was I not getting end-of-day signals on the quality side, but the speculative signals were really taking their toll on me on the end-of-day swing side. And what's amazing is that I had the least amount of capital allocated to my end-of-day swing side, but yet it was causing me the most consternation and most headaches, because whatever I would go long, if it triggered and filled, it would either do nothing or fail. Whatever I went long, if it triggered and did not fill, explode higher. Whatever I decided to not buy, that I really thought maybe I should buy, but you know what? Doesn't match all my criteria. I'll give it to all the members. You guys can have the fun. Every single time, members banked, and I watched. And this was happening every single day. Here. Every single day for the entire month of August, I couldn't do anything right on the end-of-day basis. Now, long-term portfolios, they're rocking. Day trading portfolios, they're rocking. But the end-of-day stuff is what I've made my career on. It's what allowed me to do this for a living for the first half of my investing life. And now for the past month, I just can't get anything going. And then finally on Friday, it all now makes sense. And we've erased all of that August action. We are now back below the 100 SMA. Now it's time to start looking for support levels for me to go into the long-term portfolios. The also good news is we did a quarterly portfolio reconstitution at the end of this season, at this quarter's earnings season, like always. And I told everybody, listen, I got a lot of leaders and I like them all, but every single one is extended. Every single one has V-ramped, just like the SPY, into overhead resistance without any price discovery. They're all at 3 ATRs. The only way that I'll be going long anything this quarter of those names that are in the quarterly portfolios is if they get below the 21, reclaim the 21 while in a squeeze, then I'll get long, risking to this low. So if the SPY was one of those quarterly portfolio names, as soon as it reclaims the 21 here, I would get long here, sizing my risk to this low, and then, as you can see, it would have stopped me out on Friday if this would have been a new quarterly portfolio name. Now, obviously, it isn't. There is no squeeze, so obviously this wouldn't be a trade. But that being said, that's how the quarterly portfolios were going to work. So, despite what happened Friday, I kept everybody safe this month. I didn't FOMO into the long-term accounts at all during this entire rally, this entire push. I did not FOMO into the quarterly accounts. I did not FOMO into the end-of-day swings. I maintained discipline, professionalism, and now, after Friday, it all makes sense. So what levels are we looking for? Things first, the most logical area of support for me is this 50 SMA. But to me, that looks too clear, too clean, too obvious. Also, we are heading into the seasonally most bearish period for stock market returns for the S&P 500 since 1950. The two worst months for stock market returns are September and October. So we are heading into the teeth of bearish seasonality following a quote, a mini black swan event on Friday. We have a mini black swan event on Friday on heavier volume. Elephant kill candle and golfing candle erasing a month of price action. as we head into very bearish monthly seasonality. So keep all of that in mind, which is why now we can start to look for support levels. First level I'm looking for, right there, 50-day SMA. Do I think that's going to be the low? Kind of hoping not. So now I want to find an area that was support, that then acted as resistance, that then acted as support again. Support, bounce, resistance, resistance, bounce, support. Maybe it'll be support again, right around 390. Okay? So now I have this level. I have the 50 SMA. Let's just keep adding levels, looking for confluence. Let's do an anchored VWAP off the low. Okay. In between the 50 and this 390 level. Now, let's do our Fibonacci retracement levels from the highs and the lows. From the 52-week low to the current rally high, we have a 61.8 line up with that support level. But we have a 50 fib lining up with the 50 SMA and the anchored VWAP. So it's starting to look like this should be our first hard area of support, 398. 390. Now, for one last measure, let's do a reverse Fibonacci retracement level from the highs to the lows. See if we have any more confluence. I've always had sometimes saying that word, by the way. And by the way, we have multiple fib levels right here with the 100 SMA. So we'll see if this area can't be our first level of support. But right here, no new fib levels. Aha! On the downside, we have more here at 390. So we have three key levels using three different technical analysis tools right at 395, right around there. And we have three levels using two technical analysis tools right around 390. Here's my game plan now following Friday. This was not my game plan before Friday. My game plan before Friday, before we got new critical, absolutely critical information on the price chart from the Fed. Number one, always cut your losses every time. Do you know why you never see me posting my losses on social media? Because I don't know what you guys would ever get from this. Negative 1% loss, negative 2% loss, negative 0.5% loss, negative 5% loss, negative 1% loss, negative 0.2% loss. With me never, ever losing more than the full R that I initially risked on the trade. Now, rather you risk $200 per the trade, or $2,000 per the trade, or $20,000 per trade, or $2 per trade is completely up to you and what your personal account capital and risk tolerance is. I cannot help you there or control that. You find out what. So if you went long here, let's say that this was one of the quarterly portfolio names, and let's say you're only comfortable risking $2 per trade, and this is your buy point, and this is your sell stop point. Well, you got to calculate your position size based on that $2 risk. And guess what? There's more than a $2 loss here. So you can't take this trade. Now, if your risk tolerance is $20,000, you take the high here of your trigger price, whatever that would be. To me, it would be $419.57. Subtract it from the low, which would be $411.38. Get that total divided into $20,000, and that would be my share size. And I would never lose more than that. Hard stop. If there's any loss more than that, it would be due to slippage. So that's how a professional trades. Amateurs don't do any of that. They don't calculate their risk. They just see the green. How much am I going to make? That's silly. That's dumb. That's ignorant. It's not professional. It's gambler. I don't do that. I'm a professional. So was my game plan before Friday. Any pullback to SPY 3, this 50-day SMA, if there's any support whatsoever on the 50 SMA before we got the new information on Friday, I was going to take all of the cash in all of my long-term portfolios and shove it into this market, anticipating that we have a future Fed pivot coming. Following Friday's information, that Fed pivot that we all thought might be hidden in the market, not being telegraphed to us, that's gone. The Fed is definitely going to continue with hiking rates. There is no Fed pivot coming. But who knows? Maybe Monday through Friday, we'll find out that the Fed says, hey, we're cutting rates. Hey, guess what? If they do, guess who's going to change their game plan again? Me. You want to know why? I'm a professional. I'm not a gambler. I don't have biases. I don't have opinions. I don't predict. I made a comment that we were going to hit new all-time highs by the end of the year without a 5% pullback. Do you honestly think that I really thought that was going to happen? Seriously? That is me talking up the market because I can't get size correctly on the long term, quarterly, or end of day size. Now the market is doing exactly what I think, so now here's the new game plan. We get a pullback to SPY 395 or 390. I'm going to be looking for any kind of price support via some kind of hammer, like this, like this, like this, to show me that we're finding support, and I will put 50% of the cash on hand into this tape. Why not 100% now, Josh? We have new information after Friday. It's changed. I could see us going all the way to SPY 340 now. I could see us doing an undercut and rally now with the lows. So 50% of the remaining capital in my long-term portfolios, we see any kind of support at 395, 390, I get long. We fall to SPY 380, I'll buy another piece. We fall to SPY 370, I'll do another piece. SPY 360, another piece. SPY 350, another piece. All the way down to SPY 250. And whatever cash I have left on hand, if by chance that happens, which it will not, wink, wink, hoping it does. That's the whole point when I make statements like that. Then I will be all in. If we pull back to 395, 390, I go half all in. We see the spike VIX to over 40, the equity put call go over 1, the Fed pivot and or outflow start. Then I'll buy more and I'll increase size. But right now we have new information following Jackson Hole on Friday. So this is my game plan long term. We get to 395, hopefully 390. 390 is where I'm going to do this no matter what. 395, I got to wait for the hammer bar. We get to 390 and we close at 389.99. 50% of the cash on hand in my long-term portfolios goes to work. Quarterly portfolios for this quarter remains the same. I'm monitoring all leading stocks. I'm just going to pull up random stocks. These aren't even it. So Amazon. Amazon is in a loose squeeze right now. So if it gets back above the 21, if this was a quarterly portfolio name, I would get long, risking to these lows. Tesla. Tesla is not in any way, shape, or form able to do what I want it to do, but maybe it does. If it gets back above the 21, I would get long, risking to these lows because that's the current low in the consolidation. Microsoft. It gets above the 21, I would risk to these lows. And that's how the quarterly portfolios will be operated till November, after the Q4 earnings season is over in November. And in November, no matter what is happening, I plan on buying all of those stocks. There's 3 portfolios for each, 10 stocks, 10% of the capital each, and hold for 90 days. So in November, I will be doing that. But for this quarter, while I'm willing to now trade them for the first time this year, the quarterly portfolios have been paused all year long. Why? Oh, I don't know. Who's been warning about the downtrend ever since, I'd say October or November of 2021? Who's been warning that this has been going to happen? So the quarterly portfolios have been dormant until this quarter, and then they became tradable again because of the information that we had, but I needed to see them pull back below the 21 reclaim. So now that we've got that happening, they're still in play, even though a lot has changed. I'm still willing to trade the leaders. And today's swing side, hopefully this pullback will give us now some real consolidations that I can then get some great entry signals. If you guys don't know what great entry signals are on my end, I've done them before in these video lessons. I've shown you multiple charts. There's always volume surges, BOP surges. They're almost always at either the 50 or 200 SMA or a very critical support level. And if I'm doing a speculative trade off the lows, they're always going to be right at the 52-week lows. Those are the grade A setups. Then there's grade B setups, and there's grade C's and grade D's and F's I never would ever take. So that's the game plan moving forward. And the day side, it now all makes sense. I now understand why for the past month, I haven't been getting any quality long signals. They've been few and far between. I now know why the speculative long signals on the end of day side have been random as can be. Biotechs have been the only thing that have made sense, and even then, the signals from the biotech areas that work versus the ones that don't work for me personally, my statistics could not figure out what would work and what would not. Just a byproduct of this market. So very long video lesson. My main time frame of focus continues to be intraday and day trading. This is my very first year ever day trading, quote, quote, full time. Should have started in 2020. Unfortunately, made a horrible life decision that lasted a year before I started to do this. Look at that P&L graph and a long only account. Since I started, the account got serious on October 6th. Come October 6th, I'm changing rules of that account. The break-even stops will no longer be on the full position. So that rule will be adapted. And then I'm also going to open it up and take more trades than I have been taking. Normally it's just been front side right now. But look at that P&L graph. That P&L graph is why my main focus remains intraday. End of day is my bread and butter. The setups and the signals have been weird. Once again, no surprise, V-shaped moves, algorithms. What am I going to do? Can't force it. Quarterly portfolios will wait for the 21 EMA reclaims. Long term, you have my game plan. It was a full load at the 50 SMA before Friday with the new information and new data after Friday, which changes all of this information. So all of the information I had going into Friday after Friday's session changed. With the new data, it's now a 50% load, hopefully at 390, not the 50 SMA, and then piecemealing on the way down until I have no more cash left and or we get a capitulatory bottom. Guys, if you found this video lesson helpful at all, please share it on your social media. Please tell your friends about these video lessons. I would love to grow this channel. I love you guys, and I thank you guys for being with me for a full 30 minutes. Sorry that the video lesson is so long, but unfortunately, I don't think people understand sometimes that the statements I make are not predictions. I don't predict anything. I have no clue what's going to happen in the next few minutes, hours, days, weeks, months, years. The stock market is an insane entity, completely algorithmic based now. The market of 1880 to 2008 is dead. The market from 2008 to 2018 is dead. The market from 2018 to now is this. V's, 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 90% up days, 90% down days. Adapt or die. The stock market is geometrical. It is not linear. The stock market is dynamic. It is not static. Be like water. Do not be like a rock. Peter Schiff has been calling for a crash ever since 2008. Do not be like Peter Schiff. I love you guys.